market with hope, ambition, and the dream of financial freedom. They watch videos, buy courses, download indicators, and open trading accounts, believing they have found a shortcut to wealth. Months later, most of them leave the market confused, frustrated, and financially wounded. Statistics consistently show that 90 to 95% of forex traders lose money. This is not because they are lazy or unintelligent. It is because trading exposes deep psychological weaknesses that most people are never taught to manage. Forex is not just about charts and indicators. It is about decision-making under uncertainty, emotional control, and discipline over long periods of time. This article explains, clearly and honestly, why traders are not yet profitable and what separates those who fail from those who succeed. 1. Unrealistic expectations destroy traders before they start. One of the biggest reasons traders fail is because they enter the market with the wrong expectations. Social media has distorted reality. New traders are constantly exposed to screenshots of huge profits, claims of turning $100 into $10,000, luxury lifestyles funded by Forex, promises of easy money. What they do not see: years of losses, blown accounts, psychological breakdowns, discipline built slowly over time. Forex is not a get-rich-quick scheme. It is a skill-based profession. When expectations are unrealistic, traders over-leverage, trade emotionally, chase fast profits, ignore risk management, and this is how accounts get destroyed. Number 2. Most traders do not understand risk management. Risk management is the foundation of profitability, yet it is the most ignored concept in trading. Many traders risk 10% per trade, 20% per trade, sometimes their entire account. This guarantees failure. Professional traders risk 0.5% to 1% per trade, rarely more than 2%. Why does this matter? Because losses are inevitable. Even the best traders lose trades. Without proper risk control, a short losing streak wipes out weeks or months of progress. Traders are not unprofitable because they lose trades. They are unprofitable because their losses are too big. 3. Psychology is the biggest enemy. Forex trading is a psychological battlefield. Every trade triggers emotions: fear, greed, hope, regret, frustration. Most traders cannot manage these emotions. Fear causes traders to close winning trades too early, hesitate on good setups, avoid pulling the trigger. Greed causes traders to overtrade, increase lot sizes irresponsibly, hold trades too long, revenge trading. After a loss, many traders immediately enter another trade to get the money back. This trade is emotional, not logical, and often leads to more losses. Profitable traders are not emotionless. They simply do not allow emotions to control decisions. Number 4. Trading without a clear plan. Most traders open trades without a defined plan. They do not clearly know why they entered, where they will exit, how much they are risking, what invalidates the trade. This turns trading into gambling. A trading plan acts like a rule book. It removes emotion and forces consistency. Without it, traders react randomly to price movements. If you don't have rules, the market will create chaos for you. Number 5. Strategy hopping and lack of consistency. Many traders change strategies every week. They jump from indicators to price action to supply and demand to ICT concepts to scalping to swing trading. This prevents mastery. No strategy works 100% of the time. Every system has losing periods. When traders do not understand this, they abandon good strategies too early. Consistency is what builds profitability, not constant change. Number 6. Overtrading and market addiction. Overtrading is one of the fastest ways to lose money. Traders overtrade because they are bored, they want action, they feel pressure to make money, they think more trades equals more profit. In reality, more trades, more mistakes, more exposure, more emotional decisions. Profitable traders wait for high-quality setups. They trade less but earn more. Number 7. Lack of proper education. Many traders enter Forex with little or no education. They do not understand market structure, liquidity, support and resistance, higher time frame bias, session timing, fundamentals. Instead, they rely on indicators or signals. Indicators do not teach market behavior. Signals do not teach decision-making. Education is not optional in trading. It is the cost of survival. Now 8. Misuse of indicators. Indicators are tools, not strategies. Most indicators lag price, give late signals, create false confidence. New traders often clutter charts with indicators, hoping they will provide certainty. This leads to confusion and conflicting signals. Professional traders focus on price behavior, structure, context. Indicators, if used at all, are secondary. Now 9. Ignoring market structure and liquidity. Markets do not move randomly, they move toward liquidity. Retail traders place stops in obvious areas. Institutions target those areas. If a trader does not understand higher highs and lower lows, breaks of structure, liquidity zones, stop hunts, they will constantly be on the wrong side of the market. Understanding structure changes everything. Number 10. Trading too many pairs and markets. More is not better. Many traders watch multiple forex pairs, gold, indices, crypto. This overloads the brain and reduces focus. Professional traders specialize. They know how specific pairs move, how they react to news, and when they perform best. Mastery comes from focus. Number 11. Failure to use a trading journal. A trading journal is one of the most powerful tools in trading. It reveals recurring mistakes, emotional patterns, profitable setups, losing conditions. Without a journal, traders repeat the same mistakes endlessly. If you do not track your performance, you cannot improve it. Trading lower time frames too early. Lower time frames are noisy and emotionally demanding. Many beginners start on 1-minute, 5-minute charts. These time frames amplify stress, impulsive decisions, false signals. Higher time frames provide clarity. Most professionals start analysis on daily or 4-hour charts. Number 13. Poor money psychology. Money triggers emotional responses. Some traders feel desperate, trade with rent money, chase losses, fear losing small amounts. Desperation leads to poor decisions. You cannot trade well if you need the money urgently. Number 14. Failure to adapt to market conditions. Markets change. A strategy that works in a trend may fail in consolidation. Many traders continue using the same approach regardless of conditions. Professional traders adapt or stay out of the market. 15. Trading without discipline. Discipline is the difference between knowing and doing. Many traders know the rules, understand risk, see good setups, but fail to execute consistently. Discipline is built through repetition, not motivation. Number 16. News and fundamentals are ignored. High-impact news can destroy technical setups. Traders who ignore economic calendars often get wiped out by volatility. Understanding fundamentals adds context and protection. Hashtag 17. The gambling mentality. If a trader hopes instead of plans, guesses instead of analyzes, prays instead of manages risk, they are gambling. Trading is a business, not a casino. 18. Why most traders quit too early. Profitability takes time. Most traders quit after 1 year, 2 blown accounts, emotional exhaustion. They quit just before things begin to make sense. The market rewards those who persist intelligently. 19. What profitable traders do differently. Profitable traders trade small, focus on process, not money. Journal every trade, accept losses calmly, follow rules strictly, stay patient, protect capital. They are not smarter, they are more disciplined. Conclusion. Profitability is a skill, trading is probability. Most traders subconsciously believe that every trade should win. A good setup guarantees profit. Losses mean something is wrong. This belief alone destroys consistency. Trading is a game of probabilities, not certainty. Even the best trading strategy in the world loses trades, experiences drawdowns, has losing streaks. A strategy with a 60% win rate will still lose 4 out of every 10 trades. If a trader cannot emotionally accept this, they will interfere with their system. They will exit early, skip valid setups, revenge trade, change rules mid-trade. Profitable traders think in series of trades, not single outcomes. Amateur traders ask, open quote, will this trade win? Close quote. Professional traders ask, open quote, if I repeat this setup 100 times, will I be profitable? Close quote. This mental shift is critical. Nata 21. Traders do not stick to one edge long enough. An edge is a repeatable market behavior that gives you a statistical advantage over time. Most traders never develop an edge because they switch strategies too often. They never collect enough data. They panic during drawdowns. They abandon systems before the edge has time to play out. Why this happens? Humans crave immediate feedback. Trading does not give it. A strategy may need 50 trades, 100 trades, several months before its profitability becomes clear. But most traders quit after 5 to 10 losing trades. Consistency over time reveals the edge. Impatience destroys it. 22. Traders let losses define their identity. Many traders take losses personally. They think, I'm bad at trading, I always fail. I'm not cut out for this. This emotional attachment damages confidence and decision-making. Losses are business expenses. In trading, losses are normal. Losses are unavoidable. Losses are part of the system. Professional traders expect losses. They budget for them emotionally and financially. When a trader identifies as their last trade, they lose objectivity. The market doesn't care about your feelings. You must detach your self-worth from outcomes. 23. Traders confuse activity with productivity. Many traders believe being active equals being productive. They stare at charts all day, open many trades, constantly analyze, but activity is not profitability. In fact, over-analysis often leads to worse decisions. Profitable trading is boring. Professional trading looks boring. Few trades, long waiting periods, strict rules, minimal screen time. Boredom is a sign of discipline. Excitement is usually a sign of gambling. Number 24. Traders do not master one session. Forex moves differently across sessions. Asian session, London session, New York session. Each session has different volatility, different behavior, different liquidity. Many traders trade all sessions without understanding any. Professional traders often specialize: London only, New York only, specific session overlaps. Mastery comes from focus, not exposure. 25. Traders ignore statistical data. Most traders trade based on feelings. They do not know their win rate, average loss, average win, expectancy, drawdown. Without data, decisions are emotional. Trading without data is like running a business. Blind, would you run a business without knowing profits, expenses, cash flow? Of course not. Trading is no different. A journal turns emotion into information. Information creates improvement. 26. Traders enter too early. Impatience causes early entries. Traders anticipate instead of confirm, guess reversals, chase momentum. They enter before the market proves their idea. Professional traders wait for confirmation, break of structure, rejection, liquidity sweep, candle close. Waiting reduces false entries. Patience increases accuracy. 27. Traders exit too early or too late. Many traders sabotage good trades at the exit stage. They either close early out of fear, hold too long out of greed. Both reduce profitability. Professional traders predefine, take profit levels, stop loss levels, partial exits. They do not negotiate with the market mid-trade. Rules remove emotion. 28. Traders do not understand drawdowns. Drawdown is a normal part of trading. Even profitable traders experience weeks of losses, flat months, psychological pressure. Many traders panic during drawdowns and increase risk, change strategies, abandon discipline. Drawdowns test belief in your system. If you have no data, drawdowns feel like failure. If you have data, drawdowns feel temporary. 29. Traders overcomplicate everything. Many traders believe, open quote, the more complex my system, the better it must be. Close quote. This is false. They add multiple indicators, complex rules, conflicting confirmations. Complexity creates hesitation. The most successful traders use simple setups, clear rules, clean charts. Simplicity improves execution. Number 30. Traders blame everything except themselves. When traders lose, they blame brokers, spreads, manipulation, news, stop hunts. While manipulation exists, blaming external factors prevents growth. Profitable traders take responsibility. Open quote, what did I do wrong? Close quote. Ownership creates improvement. Blame creates stagnation. Number 31. Traders do not build routines. Successful traders operate on routines. They analyze at specific times, trade specific sessions, review trades daily or weekly. Many losing traders trade randomly, different times, different moods, different rules. Consistency in routine creates consistency in results. 32. Traders do not practice enough. Most traders want results without practice. They avoid demo trading, rush to live accounts, skip backtesting. Professional traders practice extensively. Trading is a skill. Skills require repetition. 33. Traders use money they cannot afford to lose. This creates emotional pressure. When traders use rent money, borrowed money, emergency funds, they trade with fear. Fear leads to early exits, missed setups, emotional decisions. Only trade money you can afford to lose. Freedom from financial pressure improves clarity. Now 34. Traders fail to evolve. Markets evolve. Strategies must evolve. Some traders cling to outdated methods and refuse to adapt. Professional traders review performance, refine rules, adjust position sizing, stay aware of market changes. Adaptation keeps traders alive. 35. Traders lack long-term vision. Many traders think short-term. They ask, how much can I make today? How fast can I grow this account? Professionals think long-term, capital preservation, consistency, compounding. Wealth in trading is built slowly. Another 36. Traders do not study themselves. Trading is a mirror. The market reveals impatience, fear, greed, discipline issues. Many traders study charts but never study themselves. Self-awareness is a competitive advantage. 37. Traders confuse learning with execution. Knowing is not doing. Many traders watch videos, read books, learn concepts, but fail to execute consistently. Execution separates theory from profitability. 38. Traders expect confidence before action. Confidence comes after repetition, not before. Many traders wait to feel confident before trading properly. Professionals act based on rules, not feelings. Confidence is built through experience. 39. Traders do not respect time. Trading mastery takes years, not months. Experience, not shortcuts. Most traders underestimate the time required. Those who accept the timeline survive. Those who rush quit. 40. Why most traders are still not profitable. When you combine poor psychology, lack of discipline, weak risk management, impatience, unrealistic expectations, the result is predictable failure. The market is not designed to reward hope. It rewards structure, patience, and consistency. Recover yesterday's loss. I need to grow this account fast. This mindset immediately puts pressure on every decision. Why process matters more than profit. Profit is a byproduct, not a target. Professional traders focus on executing rules correctly, following risk management, journaling trades, improving decision quality. When process is followed, profits come naturally over time. When traders chase money, they break rules. The market punishes desperation. 42. Traders do not create a personal trading identity. Many traders copy others without adapting strategies to themselves. They follow mentors, YouTubers, signal providers, but never ask, does this fit my personality? Does this match my patience level? Can I execute this consistently? Trading is personal. Some traders are fast decision makers, calm under pressure, comfortable with scalping. Others are patient, analytical, better suited for swing trading. When strategy and personality conflict, discipline collapses. Profitable traders build a system around who they are, not who they admire. 43. Traders fail to simplify their decision-making. In live markets, simplicity wins. Many traders overload their brains with too many confirmations, too many rules, too many scenarios. This causes hesitation, missed entries, late exits. How simplicity improves speed and accuracy. Professional traders reduce decisions to clear yes or no criteria, repeatable patterns, minimal variables. When pressure is high, the brain performs best with simple instructions. Complex systems fail under stress. 44. Traders let hope replace logic. Hope is one of the most dangerous emotions in trading. Hope sounds like, maybe it will come back. Let me just give it more time. Price must reverse soon. Hope keeps traders in losing positions far longer than they should be. Professionals do not hope, they react. If the setup is invalidated, they exit immediately. They accept the loss, they move on. Hope is emotional attachment. Logic is rule-based execution. The market rewards logic, not optimism. Then 45. Traders do not train their emotional tolerance. Losses are uncomfortable. Most traders have a low emotional tolerance for losing streaks, drawdowns, slow growth. This leads to rule-breaking, over-risking, emotional trades. Emotional tolerance is a skill. Just like muscles, emotional tolerance grows with exposure. Professional traders train themselves to accept losses calmly, remain neutral after wins, stay focused under pressure. You don't become emotionally strong by avoiding losses. You become strong by experiencing them within controlled risk. Number 46. Traders misinterpret confidence. Many traders think confidence means no fear, no doubt, no hesitation. This is false. True trading confidence Real confidence means trusting your rules, acting even when unsure, accepting any outcome. Confidence is not certainty. It is comfort with uncertainty. The market will always be uncertain. 47. Traders do not learn from winning trades. Most traders analyze losses but ignore wins. This is a mistake. Winning trades